In this section, we're going to talk about downward asset revaluation, which is more commonly known as impairment. Impairment occurs when an asset's carrying amount is higher than the value that can be recovered from using or selling it. In such cases, the asset must be written down so that it is not overstated in the accounts. Indicators of impairment include damage, obsolescence, poor performance, or changes in market conditions. When these indicators are present, an impairment review is required. To calculate impairment, we first look at the asset's carrying amount, which is the value shown in the accounts. We then compare this with the recoverable amount, which means the maximum value the business can get from the asset, either by using it or by selling it. If the carrying amount is higher than the recoverable amount, the difference between the two is the impairment loss. This journal entry recognises the impairment by recording a loss in profit or loss and reducing the carrying value of the asset in the balance sheet. Future depreciation is recalculated using the new carrying amount and the remaining useful life. Let's now look at downward revaluation or impairment loss in practice. The company owns a machine. Cost of machine is $100,000. Useful life is 10 years. Residual value is 0. Depreciation method is straight line. Annual depreciation is $10,000 per year. After 4 years, the accumulated depreciation is $40,000. Carrying amount, or net book value, before impairment is $60,000. Due to technological obsolescence, the recoverable amount of the machine is assessed at $45,000. Because the carrying amount is $60,000 and the recoverable amount is only $45,000, we must recognise an impairment loss. Impairment loss is $60,000 minus $45,000 equals $15,000. Impairment is recognised as an expense in profit or loss. Some companies credit the asset directly, others use a separate accumulated impairment account. The effect is the same, the asset's carrying amount is reduced. After recording the impairment, the new carrying amount of the machine becomes $45,000. This is the new revalued amount, and this is the figure we use going forward. Now we must recalculate depreciation based on the new carrying amount and the remaining useful life. Original life is 10 years. Business used 4 years. Remaining life is 6 years. Depreciation will now be $7,500 per year. Notice how depreciation decreases after impairment because we are depreciating a lower asset value,